Information presented is for educational purposes only, and views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate. Information does not intend to make an offer, recommendation, or solicitation for the sale or purchase of any securities.
Welcome, everyone. I'm Jason Nickerson, President and Chief Operating Officer at Ullman Associates, and this is Meeting the Market. This monthly series is designed to keep you informed on the economic news, market developments, and trends shaping today's investment landscape. Each episode breaks down recent market activity, highlights key events to watch, and discusses what may lie ahead. With nearly 30 years in the financial services industry, my goal is simple: provide clear, timely, and unbiased insights on what matters most, so you can stay informed and confident in a constantly evolving market. So with that, let's meet the market. Starting with macro moments. The macro backdrop this month is defined by a market that's trying to balance resilience with recalibration. Economic data continues to show strength. Unemployment remains low, consumer spending is steady, and corporate balance sheets are still in good shape. But the interest rate story has shifted again. Over the past few weeks, yields in the front and intermediate parts of the curve have drifted higher. Sticky services inflation and firmer Fed messaging pushed markets to delay expectations for rate cuts. That move to the 2 to 7 year range reflects a simple reality. Investors are pricing in higher for longer with more conviction. At the same time, longer-term yields have stayed relatively stable, holding within a familiar range. That tells us that investors remain confident that long-run inflation expectations are anchored and that long-term growth hasn't fundamentally changed. Inflation itself has also been back in the spotlight. Recent data came in higher than markets expected, particularly on the services side. That's kept investors laser-focused on the next inflation print and has added a layer of sensitivity to every economic release. When inflation surprises to the upside, even modestly, it tends to ripple through rate expectations, bond yields, and equity valuations. So instead of a clean stabilization, we're seeing a bit of a split personality in the bond market. Short and intermediate yields moving up as the market digests the Fed stance, long-term yields holding steady, signaling confidence in the long-term outlook. And globally, Europe's growth outlook is improving modestly while China continues to roll out targeted stimulus. Both trends are helping international equities find firmer footing. Overall, the macro picture is one of resilient fundamentals, a cautious Fed, and a market adjusting to a slower path towards rate cuts. Let's talk about the companies driving the headlines this month. Tech continues to dominate, but the story is shifting. Instead of AI hype, we're seeing a focus on AI monetization, real revenue tied to real products. Cloud providers are reporting strong demand for AI infrastructure, and chip makers continue to operate at full capacity. But the leadership is broadening. Financials are benefiting from stable rates and strong credit conditions. Industrials are seeing tailwinds from infrastructure spending and reshoring. And healthcare is back in the spotlight as innovative pipelines accelerate and valuations look more attractive. Earnings revisions for the second half of the year are trending upward, which is giving the market a fundamental anchor, even as sentiment swings around Fed expectations. And we'd be remiss not to mention one of the biggest headlines of the year: the SpaceX is going public. And it's shaping up to be one of the most significant IPOs of the decade. A company of this scale, with commercial launch dominance, Starlink's global reach, and a central role in the emerging space infrastructure economy, has the potential to influence markets far beyond aerospace. On the positive side, a successful SpaceX debut could inject real momentum into the IPO market, signaling that investors are ready to commit capital to high-growth, high-innovation companies again. Because SpaceX touches communications, defense, satellite, broadband, AI infrastructure, and global logistics, enthusiasm around the offering could spill over into multiple sectors. But here's the flip side. A deal this large can pull liquidity out of the broader market as institutions and retail investors raise cash to participate. That can create short-term pressure on existing growth names, especially in tech and aerospace. And if the IPO pricing comes in too aggressively, or if early trading is volatile, it could raise questions about valuations across the innovation complex. So the SpaceX IPO isn't just a company story, it's a market-wide sentiment test. How it prices, how it trades, and how investors respond will give us a clear read on risk appetite heading into the back half of the year. Looking ahead as we move into June and into the summer months, here's what's on the radar. The next inflation print. Markets are hypersensitive to any sign that inflation is reaccelerating or stalling. A cooler than expected number could reignite rate cut optimism. A hotter number could push rate cuts further out. The second wave of earnings season, we'll hear from companies across retail, travel, and manufacturing, sectors that give us real-time read on consumer health and business investment. The Fed's midsummer communication. Investors will be listening closely for any shift in tone. Even subtle language changes can move markets. So any shift in communication style, any change in policy priorities, how the new leadership frames the path forward for interest rates. Summer often brings lower trading volume, so seasonal market behavior is on watch, which can simply amplify market swings. It's a time when staying disciplined matters even more. And we're entering the phase of AI infrastructure build-out, where companies are not just announcing AI plans, they're deploying capital. That has ripple effect across semiconductors, data centers, utilities, and software. And finally, the Iran conflict and the market implications of a resolution or even no resolution. Developments in the Middle East remain a meaningful swing factor for global markets. A de-escalation or diplomatic breakthrough could ease pressure on energy markets, reduce geopolitical risk premiums, and support broader risk appetite. But a lack of resolution or renewed tensions could keep volatility elevated, particularly in oil, defense, shipping, and global supply chains. Markets aren't pricing in worst-case scenarios, but they are watching closely because geopolitical shocks can move asset prices quickly and unexpectedly. So what does this all mean for you as an investor? Well, first, stay focused on fundamentals. Companies with strong balance sheets, consistent earnings, real pricing power continue to lead, and that's not changing anytime soon. Second, diversification matters more in this environment. With leadership broadening beyond mega cap tech, portfolios that include quality across sectors are better positioned. Third, don't let short-term noise drive long-term decisions. Markets will react to every inflation print and every Fed comment, but your financial plan is built for more than a single month's data. Fourth, opportunities are emerging internationally. With Europe stabilizing and parts of Asia stimulating growth, global diversification could become more compelling. And finally, this is a market that rewards patience and discipline. The long-term story, innovation, productivity, and steady economic growth remains intact. Thanks for joining me for this edition of Meeting the Market. I'm Jason Nickerson. We'll see you next time.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.